Hi, I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today on the EIA show, we were moved to Thursday because of the Monday holiday. Hopefully everyone enjoyed their 4th of July, their extended weekend. And now we get to talk about what's happening in the energy world. We talked about OPEC on Friday. We've been going back and forth on Twitter about what it means, how we think it's going to progress, and we'll provide an update in segment 3. But we want to look and provide an overview of, what is the number, what do the numbers mean, how important are they? And when we look at crude, we had big draws out of gasoline and oil. But when you look at oil, oil's moving along the lines of about 2019, very much in a seasonal norm. There's nothing too crazy about it, especially as we see that pressure on exports that we've been talking about with that big dip of about 1 million barrels. And we expect those imports to start to increase just as refiners start to ramp back up along their normal trajectories. When we look at gasoline had been building for about a month, and we've been talking about how there's usually that bump ahead of July 4th. And we've talked about how there was some shortfalls. There were some gas stations that didn't have gasoline. They were struggling to find drivers. And when you look at the data overall, and when we look at GasBuddy, when we look at Descartes talking about 9.5, was the kind of the ballpark number, and coming in at about over 10, there's a certain amount of disconnect between that. And we think that there's going to be some pullback, closer to about 9.3 as we go through and progress past this, what is really the peak of the driving season. And then we have that plateau. We continue to see some of those issues in jet fuel and distillate that we've talked about. In terms of those export side, disti demand still remains strong and will remain so, but we will see those builds start to increase. But again, it's happening very much on a seasonal line. So we really want to look at where things are going, and given the pressure from OPEC, the numbers that we've seen here, this should be enough to kind of keep us in this $73 WTI range for now until we get some more information and we look in terms of what kind of deal can OPEC come up with. What does this mean in terms of the Delta variant and some of the rising cases in Asia, and how that's going to pressure some of that oil demand that we've already started to see in some of the physical markets again as pressure comes into differentials. So before we get into it, I'd like to remind you, please like, share, subscribe. Your support is appreciated. So when we look at crude oil inventory excluding the SPR, so remember the SPR is being sold down, the money's being used to help update the system, upgrade. So we're going to continue to see those draws on the SPR. So we'll talk about that separately in a minute. But here we just want to look at those commercial crude storage. So you can see that we're moving at a fairly, the rate of change is very similar to what we saw in 2019 and 2017. So there's not too much to say in terms of where we are at this point. Obviously, we're at a lower level than there, still above where we were in that 15 and 18 side. But again, moving in the right direction as we have those imports still remaining depressed, even though those exports are starting to come under pressure. And that's something that we think is going to reverse, where exports will stay down, but imports are going to start to increase, and we're going to start to see that accelerate over time. So when we look at days to cover, because this is another way of looking at it, you can see that we're now back below 2017, but we're moving in a very similar line to where we were in 2019. And based on what we're seeing in general in terms of exports coming down, imports coming up, we think those, as we've been saying, and it's starting to happen, but just not at the pace that we were expecting. Again, those imports have been slow to show up. It's that the draws will remain. We'll continue to draw crude as we're supposed to at this point in time, but it'll just be at a more gradual rate of change overall. And then when we look at just total U.S. commercial oil storage and products, and when we look at products, we're talking about the 4 key ones for travel, which is gasoline, distillate, residual, and jet fuel. You can see that we're still above 2019 levels. There's the draws still remain fairly gradual once you start to factor in products, because right now when you look at what we've been doing, we've been taking crude, drawing that down, creating product, and now we're starting to see a little bit of that catch up on gasoline as we continue to see builds throughout the remainder of the product space. So here's where we were at obviously 2020 was its own special world in terms of storage. But here you can see that we had that nice draw. We're still above where we were back through April and May. And now we're coming back down to these levels. And you can see that we've now caught up to where we were in 2017. But when you look at 2017, when you look at 2018, this is typically when you start to see these declines. And there's that, that drawdown of storage happens throughout this period, and it really kind of flatlines as we get into the middle, middle of September, and then it starts to go flat, and then you start to get those builds. Because right now we're coming into peak driving. When you think about driving season kicking off Memorial Day, it then peaks July 4th, and then you typically have another 6 weeks or so from July 4th where you're going to stay elevated. You're coming into peak vacation time. We know people aren't flying the same way. So they will turn to the car. And in segment 2, we're going to look at miles driven. What are some of the indications from Google Mobility, from Apple Mobility, to look at, and obviously Gas Buddy, to look at, okay, well, where are we really? And is this a bit more of a shot to the upside? And we'll start to see some gradual reversals. So here, when we look at distillate, here you can see that we're moving along the seasonal norm up. There's nothing too crazy up or down, which is a fairly stable move. Here you can see we're tracking essentially 2015, and then when you look at some of the other periods, the trend is up. So to see a distillate build again is not concerning, very normal, very seasonal, and there's nothing to say one way or the other. Just because as we look at demand's going to stay strong. We're seeing it in trucking, we're seeing it in shipping. But when you think about the shift in trying to create as much gasoline as possible, you have to utilize all parts of the stack. And the U.S. is obviously a very heavy, we used a lot of coking processing on the refining side. So we have to get that blend heavier, which is where as the blend gets heavier, distillates will pick back up. So even though we're going to have that nice demand side, we're still going to have some of this additional capacity and storage just because we're going to overproduce what we're actually which is actually necessary. Now, when we look at jet fuel, you can see that we had another fairly, it's essentially stable. There wasn't too much up or down. It's kind of going flat, as we had been saying. And when you look against 2020, which is obviously that all-time high, taking out 2020, we're at a seasonally adjusted all-time high and coming back to a 2021 high. But when you look at some of the data sets, you can see some of the noise when you look in terms of when is it getting pulled to the airport, where's the demand figures. So this is why it's always important to look at the 4-week rolling average, because we do expect to see some draws coming out of jet fuel as we do get a little bit more pulled into the airport side on the demand level, because we did get a dip in demand. We expect to see that reverse, and we'll talk about that more in segment 2. Now, looking at the futures, when we look at the front months, you can see that there was a small pullback when you compare it against what happened with OPEC, where some of the reversals have been. Some of the biggest pressure has come further down the curve, because when you look, you can see that now it's May 2022 that it is that's above 65. Before it was something closer to August, September. And then you can just see that there's been a bit more pressure just throughout the curve, which is multi-phase. So let's think about why this would happen. Well, you've had a nice run. You've seen some of this movement. Are we starting to see a little bit of an increase in hedging? Not to say that hedging's happening out to 2025, because it's not. But it's when we look closer, even going out to 2023, are there some that are starting to look at some puts? Maybe starting to sell some calls, especially at the front month, trying to lock in some of this, some of the premium, given some of the volatility has increased. So if you're selling calls, you're going to pick up some of that vol. You're going to pick up some of that, some of the benefits in the options land. So again, we're not going to get too deep into the Greeks, but those are things that can start to happen. And then there's also, well, what is going to happen with OPEC? How quickly are we going to see them come back? What has the UAE done in terms of investments? Why do they want their baseline at 3.8 instead of 3.1? And those are things that we're going to evaluate a little bit further in segment 3. So then when we look at COVID net changes, we just want to look at where some of the changes happening. You can see in the U.S. they've stopped going down. Same with Europe. You can see the U.K. has seen some elevation, and on the worldwide side, you can see it's kind of flatlined. And this is really being equated to the Delta variant in these specific locations. Right now, we have to look at what are the trends so far, and so far the trends are positive in terms of seeing an increase in cases, not starting to see an increase in hospitalizations and or deaths, which is a positive. There's typically, from start to finish, there's a 2 to 4 week lag between case count increases and hospitalizations. So we should start seeing hospitalizations right now in the UK, and we're just not seeing that growth, which is a positive to show that the vaccines are effective, where even if you do get the variant, it is keeping you from getting exponentially sick and needing additional care. When we look at India, you can see that there's been a little bit of a slowdown, still moving in the right direction. Asia Pacific overall has started to actually rise again. And when you look at Thailand, Japan has had a big increase, and they're going to put parts of Japan on lockdown and, I should say, a state of emergency ahead of the Olympics to try to keep some of those spreads from happening. South Korea has had another spike. When we look at Malaysia, something similar, even though they've been in a 2-week lockdown, we're still not seeing that actually roll back. Australia has extended their lockdown. And when we look at Brazil and other parts of Latin America, where not only Delta variant is an issue, now we have Lambda. That is becoming a bigger issue because Lambda has similar proteins to Delta and making it a bit more contagious. But so far, based on what the testing has been done, the vaccines are effective, or we should say non-Chinese vaccines are effective, because we've seen some of the failures on the Chinese vaccine side. But these are things that we're going to talk about a bit more in the Econ show. So now when we look at the draws coming from the U.S., so here we had a draw of 6.87 million. Pretty much across the board. Cushing coming into the weekend actually had a little bit of a build. That caught up. There was a draw of 610,000 barrels, bringing that about 9.8 million below the 5-year average, but still in line when we look against the last 15 years or so. PAD 1 had that slowdown in draws. It was only down 260,000 barrels, starting to get a little bit closer to the 5-year average. Where we saw the biggest draw was in PAD 3, which had a draw of 4.41 million. And this is, again, what we've been talking about with some of that disconnect, where they're trying to work through some of that excess storage that's in PAD 3. But we're starting to see those imports show up. We did get a little bit of an increase in floating storage, and now we will start to see some of that come through. PAD 5 had a small build of 250,000 barrels. And again, these are things that will will continue when you look at where imports are coming. PAD 5 is going to continue to see those imports. And then when we look at what's coming out of Canada, PAD 2 will stay strong. And then where we're going to see the biggest increase is going to be PAD 3. And it's important to understand, even though we're talking about an increase in imports, we still expect to see crude draws. It's just the speed in which they're drawing down. And then once you take in the SPR, you can see that the SPR had a fairly big draw, bringing the total to 8,050,000 barrels, 8.05. When you look at just what has happened so far, that is going to continue. It should be extended. On the other side, you can see that production was up 200,000 barrels to 11.3. This is coming a little bit much closer to where we are. We're at about 11.35 on our way to 11.4. When we look into July, and we'll talk about this tomorrow on the Frac Spread Show, we're going to continue to see some of these spreads come back to work. And by the time we get to the other side of July, we expect to be closer to about 260 on an exit rate. So then when we look at floating storage, stockpiles fell by 10 million around the world. That has started to reverse in East Asia and the ARA. The ARA, or Europe, had a build of 1.7. Starting to see some of the increases in east of Suez, but obviously the U.S. had that close to 7 million barrel draw, which is going to keep us moving in that direction in terms of the decline. we'll start to see east of Suez not so much rise, but just go sideways, which when you look against the 5-year is really where it's happened so far. And when you look at west of Suez, which is US and Europe, what we're talking about is that, when you look at that 5-year average, we typically draw this period of time. Where you saw the acceleration, we're just saying that it's going to slow down, and it's going to be at a pace that is very similar to what is kind of seasonally normal or expected at this time of year. Now, on the floating storage side, as we were saying, we saw a big uptick in crude in transit. That as it goes into transit, then it goes back into storage, and it's just that timing delay. And we started to see an increase. There was about an increase of 4 million barrels of floating storage, and you can see it was driven really by west of Suez starting to pick back up. East of Suez is essentially flatline with a small uptick, and we just expect to see more east of Suez increases over the next few weeks, as we did get a big increase and another big increase on crude in transit, which just means that it's coming out of floating storage, going into transit. Then once it shows up, it'll fall back into that storage. Some of the more concerning things when we look at travel restrictions and what's happened in general. So, again, the Americas had a big drop in travel, and that's really driven by Latin America. When you look at some of the variants, some of the pressures that have come into that region, which is what, even though the U.S. has had a nice uptick, we're seeing some of that pressure in the Americas. When you look at rest of Asia, you're seeing that kind of flat line. China has also failed to recover. They're, again, kind of sitting at this 90 to 92% of normal, which is a mixture of an economic problem, because as we keep talking about, the economy is slowing. There's a lot of there's some struggling there. But now we're starting to see some restrictions come back into Europe. Nothing crazy. It's just more of a precautionary level. But it's also, and we've talked about this many, many times, so I apologize, but it's also a certain amount of how consumers will change their behavior in response to, news of an uptick or trying to avoid some unnecessary exposure. And those are things that are happening more in the rest of Asia as well as Europe, which will keep some of the gasoline demand figures a bit depressed on a global level when we look abroad. So now when we look at PADD 3, you can see that we've had that steady draw, but the draws are still in line with 2017 and 2019 when you look at those declines. And what we're saying is that the declines will continue, just at a bit more gradual pace, and will start to look more like 2016 and less like 2019 and 2017 when you just look in terms of where things normally are right now and where those imports are going to be. That the imports, the increase in imports, decrease in exports, will start to see that flatline a bit. Then when we look at Cushing, you can see that we had that nice drawdown. Now we're starting to get some of that flatlining, which is what we've been talking about, where the rate of change will slow gradually. And as we said last week, we expected to see additional draws. Just the rate of change was going to slow. If you remember, we've been over 1 million barrels. Now we're at about 600. It's going to be the pressure from exports overall is going to adjust, where those draws come. And we still expect to see draws. It's just, again, not at the same type of rate that we have seen so far. Then when we look at imports, when we're talking about crude, you can see imports were down 534,000 barrels a day, which is really being driven by PADD 3 and PADD 5. So PADD 3 was down 254,000 barrels, and when you look at PADD 5, it was down 441. Now remember, PADD 5 had a big increase, now a big decrease, and it's just going to kind of be that timing side of when does it show up, when does it get unloaded. PADD 2 had the increase of 250,000 barrels, which is 240,000 above the 5-year. That's going to remain the case. That's going to continue. It's PADD 3 that when you look at the fact that we're about 1.6 million barrels, 1.65 million barrels a day below the 5-year, almost 2 million, a little over 2 million above below the year over year. That's where we see that delta, and that's where we're going to see some of that growth. And when you look at South Korea is putting out more gas oil exports. We're seeing some of these shifts. So it's going to be a matter of where are the shifts happening, who's exporting what where, and then how is that going to result in either an increase or decrease of oil demand based on what the refiners are going to be doing. So when we look at runs, as we were saying last week, there's typically a little, that drop as we go into July 4th, and then you start to see the increase. There was a small decline of about 0.7% or 182,000 barrels a day, coming from 92.9% utilization rate to 92.2. That's something that we'll start to see reverse. And when you look at PADD 3 was the driver. You had a drop of 190,000 barrels a day of throughput, taking us about 376,000 below the 5-year average. And in order to get and to see that rise, we're going to have to see a heavier slate of crude being utilized in order to see some of that come back into the market on the capacity side. So now when we talk about implied demand, here's where you can see that big increase of 870,000 barrels a day coming into the gasoline pool, bringing us to what is an actual record of 10,043,000. So 10.043 million versus last week of 9.17. So we were expecting to see an increase closer to about 9.5, just given that there's typically that pre-fill ahead of 4th of July, making sure that the gasoline is available, and then we start to see that come back towards that level. Instead, instead we got a much bigger push. And we'll come back not to 9.2, but closer to about 9.3, 9.5, and kind of stay within that range as people, finally saw their families. And I should say saw their families with a certain amount of comfort instead of kind of this concern of, are we allowed to hug? Can I come too close? Should we stay outside or go inside? There was a bit more of a enjoyable backdrop. Now, distillate was the one that had a fairly big drop of 330,000 barrels. Again, that's a lot of timing. People go home for the holidays. A little bit less trucking, and for those that traveled, the truckers were right back at it very quickly after. Jet fuel had a small drop of 64,000 barrels. As we've been saying, it's just going to kind of be a sideways move at this point. We don't see too much of an explosion up or down, but really kind of a steady movement or chevron impact sideways. And then propane, again, is going to stay strong, 135,000 barrel a day increase. But again, it's just 315,000 above the 5-year. Even though prices are well over $1, we're still seeing a lot of demand internally, externally. So again, those are things that are going to remain strong. Now, when we talk about movements and shifts, so South Korea sold 2 cargoes of jet fuel for August loading at a discount of about 40 to 50 cents a barrel to Singapore. So we're starting to see movements again. As we talked about, there's some increases in COVID cases that is putting additional product on the water. And right now, South Korea being one of them, some of the export facing refiners have talked about cutting back on runs, and not a huge amount, like 3 to 7%. And it's really because you're seeing some of the softness on demand internally that is slating more to be exported because they're not seeing the same amount. So you have to make room in that sense. And those are some of the adjustments we're seeing in Asia as some of those exports increase. Now, European gasoline arrivals increased to a 5-week high in the 7 days through July 1st. As we were saying, we're going to continue to see some of that acceleration. We're at the most since May 27th, being at about 483,000 barrels a day, which compares to 272,000 barrels in the previous week. 14 tankers were discharged, but remember, there was also that oversupply coming into PADD 1, or at least New York Harbor. So we actually saw some of it divert down, which just means that things that should have been counted this week will now get counted next week. So we expect to see gasoline imports remain elevated for another week or two, again, depending on when they actually port and have the chance to unload. So then when we look at floating storage in the U.S., you can see we bounced off of 0. We're now back over 1 million barrels in storage. That is something that's going to continue to grow. And again, not grow in the sense where we're going to explode back to 5-year highs, but just closer to the normal side. We expect to see this get to the bottom of the cloud. And the cloud is moving in our favor. As you can see, there's typically a drawdown of floating storage. Instead, because we never really had had much to begin with, you're going to start to see it build, and just the comps are going to be easier. Not that we're getting this explosion, it's just more the comps are going to become more in our favor, but we will start to see that increase. And here's where we look at the imports. Imports had a big drop, still above the lows that we had back in May. But again, we were expecting to be closer to the, within the cloud, but at the bottom end of the cloud. Instead, we fell back out of it. That's something where we think we're going to have that spike. And as you can see, typically imports remain fairly elevated. But when we look at what comes next and what's out on the coast, we expect to just come back within the bottom of the cloud. But again, be within it, not below it, as we have been. So then when we look at imports into PADD 2, as we were saying, we thought we were going to see an increase and just stay within the top of the range in terms of above the 5-year but below the top. So again, this is something where we think it's just going to continue to go sideways. PADD 2 refiners still remain robust, still operating at strong utilization rates, so they're going to continue to need the crude, which is going to keep those imports elevated. And now when we look over the last 29 years in terms of utilization rates, you can see that we're just below average. There's really nothing to say one way or the other. Based on what we expect to just hug this 29-year average. We're not expecting this huge increase or decrease, but really kind of a steady 92, 93, maybe 94%, but not off the highs that we've seen of 97, 98, and closer to kind of that average that we expect, as PADD 3 is kind of the bigger, will be the bigger driver, as a lot of the other regions have already kind of maxed that out. So that's where PADD 3 is going to be the one to watch, which is why we're very confident on that import side. And we see the boats, they're there. It's just a matter of when do they come into the market and make room. Obviously, there's a slowdown because of the holiday. Now that will pick back up, and we should start to see that reverse and those imports to increase over the coming weeks.